All right, guys. So welcome to another episode today, brought to you by Alpha Moguls. Hope you guys enjoyed the video. Please like, subscribe, help out the channel grow. So today we're gonna go over how to grow your account from small, let's say $200, which we're gonna be working with, to grow it exponentially using good strategies. And, if you're lucky enough to have woken up today and had that nice stimulus check, maybe you could use $200 and start. So we'll be going over that today, and we'll leave a link in the description below. And if you guys click on that, you get a free stock and we get a free stock. So we all win. So Tiago, I'm gonna kick it off to you.
Yeah, we started this account with $200 last week,
Right.
just to be like an example, showing that you can do nice strategies that are safe with small accounts. So instead of just buying options and hoping it goes up, and you gotta go up quickly because otherwise you lose values every day. It's
Right.
less than 50-50 chance of profit. You do options by selling options, actually getting credits for that.
Mm-hmm.
And you can do that with small accounts. Few people know that. They think you need just a lot of collateral, or you need to own 100 shares to do a cover call.
Right.
But you can do some nice strategies, safe strategies, selling options, collecting premium with a small collateral.
Okay. Okay.
Yeah.
So let me ask you. So the options that you're gonna do, right? The you're gonna do, because I know about covered calls, selling puts, but you're gonna do more. Like, what level is this? Is this level 2, level 1?
This one is level 3 option,
Okay.
and it's simple to be approved for level 3 on Robinhood.
Okay.
You can just go on settings,
Uh huh.
and under settings, you just go to investing, and then you're
Okay.
gonna see the option here, option
Okay.
trading. You're gonna see the option to upgrade to
Right.
level 3. They don't ask anything. You just click upgrade, and then you're gonna receive a message later on saying that you're approved,
Right.
and that's it. And then you're good to go to do credit spreads. That's the strategy we're doing right now.
Okay.
And I'm gonna show you here example of one that I already closed that got a nice profit. It
Right.
was one with AMC.
Okay.
And the good part is that you don't have to be right with the direction of the stock. The stock can go up, stay stagnant, or even go down a little bit, and you still make a profit. So you
Mm-hmm.
you have time on your favor, and you need low collateral if you do a put credit spread. Let me show you here
Okay.
an example. So let's choose 2 weeks from now. It's expiring in April 1st.
Okay.
Usually I choose between to 2 to 6 weeks, depending on the stock.
Right.
Sometimes even just 1 week, if the stock has a very high premium, you can collect a nice premium and just expire in just 1 week.
Right.
I'm not gonna cover all the details of how selling put works, but we're gonna make a video soon
Okay.
with more details. But this one is just to show you that it's possible to do some good strategies
Mm-hmm.
with a very small account. So
Nice.
instead of just selling a put that you need, look at here, I'm going to show how much collateral you need.
Okay.
Let's say I'll choose the
And
13
real quick,
strike
right? So
price.
selling a put, what you're basically saying here
Mhm.
is on expiring April 1st, you're willing to buy AMC at the strike price of $13, right? So if it's $10, you still got to pay the $13, right?
Yes, yes. And don't confuse this with buying a put. When you buy a put, that means you just want the stock to go down. And if it does not go down fast by the time the expiration dates, you're going to
Mm-hmm.
lose all your money. Your option will expire worthless. So when you sell a
Okay.
put, you are on the other side of you're like you are the casino. You're not the gambler.
Right.
You
Exactly. That
so
makes
in
sense.
this
Okay.
case here, if you just choose, let's say the strike price 13, that means you're gonna, if the stock goes down all the way to below $13 on the expiration date, you're gonna
Mm-hmm.
be you have the obligation to buy it for $13, but you collect a nice $210 premium for each contract. But
Okay.
you need let me put here one contract just to give an example of the how big collateral you need. You need
Right.
1300. You know, so I'm going to show you how to do a very similar strategy, but you don't need to have all that collateral.
Right.
All you need to do is at the same time that you sell a put, now just you mark here that you want to sell this one.
Mm-hmm.
And now you just change to buy put.
Okay.
You choose one just below it.
Mm-hmm.
That's it. Now look at the difference on collateral you need. You're gonna
Wow.
collect. So with a small $200 account, you can even sell. Let's try like 5 contracts.
Right.
Now that and you can do it because you need 250 collateral and you're gonna collect 135.
Wow. That's
So
great.
that's big return if you think percentage wise.
Sure.
You know, and here's the difference
More than
when you
50%
do.
return.
Yeah, here you're getting a credit because you're selling a put and you're buying one cheaper. So that means that the one that is more expensive,
Mm-hmm.
you're collecting a credit, and
Okay.
this one reduces by this one. And the only collateral you have is the difference between the strike price. So the difference here
Okay.
is 50 cents. So 50 cents times 100, because everything options you have to calculate times 100 for
Okay.
contract. That's $50. So since I chose here 5 contracts, that
Right.
means it's 250 collateral.
Man, so okay. So I mean, this could potentially be a 50% or more, 50% return, right?
Yeah, but
I
I
mean,
like to be even safer on here.
okay.
I would do it. This one you gotta making almost 50% on your money in just 2 weeks, less than 2 weeks.
Man, we're
I
gonna
like
call
to
this a
minimize.
Ferrari fund because we keep going at this rate, man.
Yeah, and how to turn 200 into 200,000, right?
That would be the goal, my
So,
friend. Let's go.
okay, so let's choose here. If you want to be very safe,
Mm-hmm.
just choose this one here. You sell the $11 because the more you go down out of the money,
Mm-hmm.
the less you're gonna collect.
Of
But
course.
at the same time, you only start losing money if the stock goes down to the strike price you choose.
Mm-hmm.
So in this case, if it goes up, we collect the full premium. If goes stay sideways, full, and then if you get below 11, so you start to lose money.
Right.
But I'm gonna show in other videos in the future how to never lose money. You know, it's not guaranteed because we're not
There
financial
are no
advisors.
guarantees,
Yeah,
exactly.
but there's always it's all about doing the maintenance on the strategies that you can always move forward to another month and collect the new credits,
Mm-hmm.
and so you don't lose the money. Okay, so let me show you here that so I'll sell this one and buy
Okay.
this one.
So you're always selling the higher amount, and then you're selling a put on the higher amount. You're buying a put on the lower amount, right? So they're basically within like the same, like from 11 to 1050, like they're one right underneath the other, right?
Yeah, that's why you need a low collateral, because
Okay.
you this one is protecting this one,
Right. Okay.
when you do it just this one like naked.
Mm-hmm.
It's not actually naked because you need a big collateral if you're just doing this selling the put by itself.
Okay.
But when you do this here, it's like a protection against this one, because when you're selling, when you're buying, so the only risk you have is the difference in the strike price.
Okay.
So look at here now. This one it's still a nice $95 on a
Well,
250 collateral, and you're safer here. The $11.
right.
If you want to be a little more greedy, if you're extra bullish,
Hmm.
you can do it closer to the share price. But I was like higher probability of success, going down here.
Okay.
You see here the chance of profit. That the farther you go down,
Right.
the higher the chance.
Because the
If you can
likelihood of
stay
it falling
close,
that low is a lot less.
yeah. If you want to be, if you have a bigger account and you want to be extra safe and still make a nice money, you can
Mm-hmm.
just go to the 80% chance.
Wow.
Let's see, still collecting. Now see the collateral is bigger now. It's just because the difference
Mm-hmm.
in, let's see here. uh, I think I have two orders at the same time. That's why
Okay,
I got.
okay. No,
Okay,
it's all good.
yeah.
It's good to
So
learn. If you see it's not right, probably double check
yeah,
because you don't want
that's
to.
good that happened that because always make sure you're not having too many an extra
Yes.
option here that you don't want it.
Yes, exactly. And I got to tell you real quick. So I kind of told a friend of mine, a relative, no names, and I said, make sure you sell a put on this particular. And what they did is they bought. So when
Yeah,
they
that's
bought,
be
they,
careful.
they lost a bit of money within a few hours. So just make sure you guys are paying
Yeah, always
attention to what you're doing.
pay attention here and always sell. Make sure it's a credit. Just look here when Robinhood they did it nicely. They put if I do the opposite, if I buy in the expensive and sell in the cheap, it's not gonna say credit here. So make sure it says credit.
Gotcha. Okay. So you always want to sell the more expensive one, you want to buy the lower strike price.
Yeah.
Gotcha.
So
Okay.
now we are at the 80% chance of probability,
Mhm.
and we're still collecting like 20% on the
Yeah.
money in just 2 weeks. So and you're very safe here. So the larger the account gets, you can be even safer on the
Sure.
strategies. So
Right.
protect you better. So
Exactly.
that's it, and then you can just wait until the expiration if the price is still above the strike price
Hmm.
and let expire, or I prefer to, as soon as it hit 50% of the maximum credit,
Okay.
I cash out and do another one.
Okay.
That way, I back tested that already, and on the long run, you make more money that way. Don't just wait for expiration.
Right.
Just close the position by buying back as soon as it hit. So that's in this case here. I can put a order as soon as this one fills. I create a new order that instead of good for the day, I put good until cancel. That means
Mm-hmm.
stays going until it reaches my target. And then I put, let's say, as soon as I can buy back for $25,
Right.
making $30 credit, you can close the position for me, and that's it.
Now let me ask you this, right? So in order for that to happen, so AMC right now is at 13.95. For
Yeah,
you to make that happen, does the stock have to go up or down?
that's a good part. It can go up, down, and still make you get the credit. Because if it goes up, you just, as soon as it goes up, you get the credit
Right.
faster.
Okay.
But if it goes down
Hmm.
and it does not go below the strike price, you just wait until the expiration date, and you're gonna collect the money. So if it goes up, you make money. It stays stagnant, make money.
Right.
And so just always pay attention to your strike price. Make
Okay.
sure it does not get close to your strike price and the expiration date. And if it gets dangerous, it gets close to expiration to your strike price. Now you're gonna have to subscribe and watch the next video that
There you go.
we're gonna
Thank you
show you how to do
guys.
the maintenance.
Thank you guys for watching. Tiago, as always, thanks, bro. The options guru right here, guys. So leave a
Thank you.
comment. Tell us what you think. Take care, guys. Appreciate it. Take care.
Yeah.